Hello traders, this is John Kicklighter, Chief Strategist for DailyFX.com. Here, the Forex strategy video in which I want to cover a particular currency's monetary policy outlook. We've been spending a lot of time talking about the Japanese yen and the expectations for the Bank of Japan to offer a second round QE2 program. We've been talking about the Fed and its taper leanings and the time frame for that, and those do deserve our attention. We've covered them quite well, and we'll continue to cover them going forward. But I do want to touch upon a currency that has received perhaps some of the best 2013 performance that we've seen, largely on the basis of interest rate expectations. And there's a good chance that it doesn't deserve these forecasts, or at least it's overrun the actual fundamentals that would support this speculation. Now, this I've alluded to a couple of times, but it is the Bank of England and the impact that it has on the British pound. We've seen the sterling go through in 2013 two significant waves. The first wave was the significant wave to the downside. This move was instigated on the expectations that the recession that the UK was still mired in at that point would turn into a dreaded triple dip recession. Subsequently, that would be forcing the Bank of England into a corner in which they would have to offer some further means of stimulus, pulling them down the same rabbit hole that the U.S., the Eurozone with their LTRO programs, and many others have had to go down. This in turn would hurt the currency, and we've talked about why stimulus or monetary policy can lift or pull a currency down, so I won't go into that detail. But those initial expectations were what drove the cable to the lows that it saw that year, or this year. Now, subsequently, after we've found out that the new incoming governor, Governor Mark Carney, who currently stands in the position, would not take on an immediate I will do anything necessary stimulus approach, there started to be some buoyancy. And subsequently, after he came into power, we did see that there was a positive turn in economic activity. Subsequently, expectations of that triple dip recession and massive stimulus program evaporated. And subsequently, the pound instigated its second significant swing for the year, this really aggressive rally. All right, now this rally has been well deserved from a fundamental perspective and certainly from an interest rate forecast perspective, but those expectations have gone to some pretty substantial heights. You can see the performance that the pound has been able to win on a pound dollar perspective. Yes, the UK interest rate is comparable to the US, so it doesn't necessarily deserve to be at the very bottom end of its range, but at the same time, neither does it actually show the kind of strength that we've seen just in the past 3 months, or I guess 5 you can call it. Now, if you look at the pound against many of its other counterparts, you see this similar strength. Right, euro pound, though it's given back recently, you have seen some gains. We look at something like the pound Kiwi or pound Aussie. This currency is gaining against high yield currencies. The Aussie and Kiwi have been struggling individually, but it does put it into context for us. The pound yen obviously is going to do much of what the pound dollar does, but it's going to do it to a greater degree because the pound yen is leveraged by the Bank of Japan, which puts an extreme alternative in terms of the monetary policy bearings. So we do get a very good sense overall of how the pound has performed. Now, this strength, however, yes, we have seen a recovery in economic activity, and it does bode very well for the UK, but we've seen that the economic activity for most of the global economy has improved to some degree, and the UK certainly does lead that charge, but it is unlikely to maintain that lead. Furthermore, interest rate expectations have grown to some excessive heights. In fact, we've seen the interest rate expectations officially through swaps rise or move forward from sometime in 2016 up to 2015, and now it's potentially even earlier than that. We've actually seen from a marketing report, which I have here, market in which they suggest, or they took the views of interest rate hikes expectations from households, and their forecast was for a significant probability of a hike sometime in 2014, so next year. That would put them well ahead of most of their counterparts, maybe not the RB and Z, but certainly the Fed, the EC being the Bank of Japan, which would justify the pound's current strength. However, are these reasonable expectations? They're not likely reasonable expectations. This is over running those consensus. All right, and while a household expectation is not going to be the same as a rate watcher or a FX trader, you're going to get some level of that skew in these market conditions. So interest rate expectations are very highly priced, and even if it is in early 2015, that forecast, those projections are not going to be realized or offset for a long time. So speculation itself, if it does grow fatigued, will start to curb. This is especially true for, when we start to see the other sides of these currency pairs, like the pound dollar. When we start to see the dollar side of the interest rate forecast pick up, there's going to be an offsetting factor. Now, I want to look at the interest rate forecasts and what we can garner from them. Here we actually see the pound dollar versus the difference between the 2-year yield expectations, the 2-year treasuries for the U.S. and the 2-year treasuries for the U.K., or as they call them, the gilts. The difference between these two, and the reason why I use the 2-year forecast, is because most of the expectations for that first hike from both countries falls within the 2-year spectrum. All right. Now, as you can see, we have seen the pound hitting its head against, or the differential hitting its head for the UK rate forecast at about 22 pips, or basis points. And this coincides nicely with the range top that we had here. Now, of course, there has been some recent deviation as the pound has been able to drive through that resistance. The UK differential, however, has not. We can look further at this in terms of just individually the UK's perspective. Here we have the 2-year yield forecast and the 12-month interest rate forecast. All right, or sorry, that's the UK yield, not the yield forecast. You can see that yields have improved, but they haven't mirrored the same strength that the pound has benefited from these past couple of weeks. All right, so where the pound dollar has seen that drive above the 162.50 level, or the pound yen, which has jumped above 166, 167, you don't see that same kind of performance in the actual yields from the British pound. Furthermore, the interest rate forecast has also kind of stalled a little bit. You can see here in the orange line, this has not really advanced very far. The left axis actually coincides with that. Expectations of a hike, that first hike, have not really picked up, nor would they in a 12-month period, though you can start to see the early vestiges of speculation, especially speculation that has become as hot as it has for UK interest rates. So we have something of a significant pickup in those forecasts, yet are they reasonable to the extent of what data we have and what data we can expect and what we can expect from the central banks? That's the question that we have. Now, when we look at something like a pound dollar, this suggests that there is a very heavy leaning expectation, a lot of speculation behind that rate hike and its inevitability. Now, while it might find a rate hike, what happens after that first rate hike from the BOE? It's far too early to even tell when the first hike will occur, much less to consider the consistency after the first move. So I'm looking at this pound dollar, and as you should be, we're going to be walking through each day where we have meaningful event risk that can tap into this kind of speculation. Now, we're not going to have another BOE meeting until next year, of course, and even when we do have that next BOE meeting, they're probably not going to give us much in the way of clarity for the next policy decision, whether it be bullish or dovish, or hawkish or dovish, because they're not going to, or they don't really expound upon what their expectations are beyond that actual meeting. So we're going to have to look at data. Data becomes much more important for the UK and UK monetary policy. Now, looking at the event risk that we have this week, I know a lot of us are focusing on the FOMC decision and the BOJ decision on Friday. We should. But be very aware that the UK and British pound can see quite a bit of volatility itself on its own interest rate forecast. In this upcoming session, we have inflation data, important inflation data. Through the UK CPI is going to be probably the key, but we also have upstream inflation figures in factory and retail and housing inflation prices. These are going to be key data. If there is no imminent threat of inflation, the Bank of England is unlikely to realize the speculators' expectations of a near-term hike. All right, and if that pressure doesn't start to show itself, those very distant forecasts of a hike are going to become a little bit more difficult to sustain. Following this round of event risk and into Wednesday morning, as we will see a lot of headlines will be dedicated to the FOMC, also be aware that you have notable UK data, the Bank of England minutes, and November employment figures for the UK. These are an important combination of data. They will certainly illuminate whether there is a pressing need for rate hikes or whether the Bank of England's constant reassurances that they're going to keep interest rates extremely low and not even contemplate that hike for the next, let's say, year and a half, maybe more. This will be somewhat confirmed through this data, or maybe it will be done. Maybe we will see a substantial improvement in both employment and inflation, and that will subsequently force the Bank of England's hands on monetary policy. We'll see. But as it stands, with the data that we currently have, interest rate expectations built into the British pound are significantly skewed. If we do not see something to support those expectations in the near future, we might see that this deviation in performance between yields and yields expectations will start to pull the pound down, not just against the British pound US dollar pairing, but against many of its counterparts. All right. So keep an eye on this data. Keep an eye on the British pound. It fits into the global monetary policy scheme we've been talking about. We won't call it currency wars because the central banks won't, but they're definitely engaging in monetary policy wars, and we want to make sure that we are following each of the majors to see what those central banks are doing because it will significantly impact our medium and long-term trades. Good luck trading out there, guys, and we'll do another Forex strategy video tomorrow.